Some developers have so much going on, or at least claim to have so much going on, so many plates spinning, that there's little chance that any of it will get built. And that kind of developer is just a time sink. Wind, I'm not sure. Trump pretty much hates wind. I don't see that moving very quickly. The planet is going to be covered in data centers, right? And so data centers need energy, data centers need on-site energy generation, they need on-site storage so that they are not driving up the cost of electricity for everybody in the location where they're located.
Welcome to the MacroMashup podcast. I'm your host, Neil Winward. This podcast is sponsored by Dakota Ridge Capital, your energy investments partner, helping developers partner with family offices, banks, corporations to make smart, clean energy deals and maximize government tax incentives.
MacroMashup.
All right. Today, Neil, we're doing the inverse. Usually you're the host of MacroMashup. So today it's going to be a fun one because I get to interview you. And we'll start off by asking you to introduce yourself.
Sure. I'm Neil Winward. I'm CEO of Dakota Ridge Capital. And I'll give a little bit of an overview as to what I do. But Dakota Ridge Capital works with clean energy developers and investors in clean energy to help those projects get built by making sure that they take advantage of all the government incentives that are available to them.
Perfect. Today, that's what we're going to talk about. We want to know about how clean energy financing really works and how Dakota Ridge Capital goes about structuring those deals. So let's start off. Okay, let's say a new investor comes to you. What's the first thing that I would need to understand if the transaction is a fit or not?
Yeah, that's a great question. So, really, the facts and the chemistry have to work, by which I mean the project itself must be sound with a convincing pathway to completion, and the developer has to be credible. Some developers have so much going on, or at least claim to have so much going on, so many plates spinning, that there's little chance that any of it will get built. And that kind of developer is just a time sink.
Speaking of developer, what does a project look like that would be a immediate yes for you?
Sure. You have to start with a business case. What need does this project meet? What problem is it solving in whichever domain it's aiming to operate? And is there demand for what this project is going to produce in that particular location? And is that demand evidenced in the form of take agreements? And then you work backwards into the project's soundness. Can it be built in the site chosen? Who's building it? What does the EPC contract look like? Does it have the inputs that it needs to be able to process through and satisfy its offtake obligations? And does it have a well put together financial model that shows all of these elements? And how does it aim to build its capital structure to finance the construction and operations? Is it entitled to tax credits, for example?
Those are a lot of demands. So I'm wondering, what would a real world example look like? You don't need to name names, but I would love to understand how you help the investor or developer go from reaching out to you to actually closing one of these deals.
Yeah. So let me give you a couple of examples. One that has been done for a while now, and one that's pretty close to getting done. The one that was done is it was a 16 anaerobic digester project, which basically means you take, how should I say this politely, cow refuse, right, that would otherwise sit in lagoons and emit methane into the atmosphere. And you put that into a digester, which is like a human stomach, really, where it cooks the manure and ultimately produces a highly refined form of methane. And you put that into a pipeline and send it to California, where they'll pay you with low carbon fuel standard credits. So that was a project that solved a problem for local farmers. It took methane out of those lagoons and put them into and produced the methane. So it solved a problem for the farmers and would even give some, fertilizer products back to the farmers that they could use. And then it solved a problem in California because it gave a low carbon intensity score source of methane that could be used in terms of fleet vehicles in California. And so that was the problem that was solved. Now, it was also eligible, that facility was eligible for investment tax credits. And when it started life in 2021, it was a relatively small amount of tax equity that was needed. And by the time it was in service, it actually had been scaled up by the Inflation Reduction Act, and it was entitled to about 5 times the amount of investment tax credit that it started off with. So that was a huge sort of commercial impact. And it was a complex mixture of different elements, different characters, different constituencies, stakeholders that need to be pulled together and tied into a completed project over a period of months. That's one that has been done. One that is close to getting done that I'm working on at the moment is a clean hydrogen project. And this is the first in a whole pipeline of projects. And this one is being built in California. And there are two elements to that. There's the hydrogen production using an electrolyzer, which takes water and electricity and uses the electricity to split apart the water, the H2O, into H2 and O, and takes the H2, which is the hydrogen, and then puts that into chilling, compressing, storage, and then distribute it to fleet vehicles who use that to power them. And so that is entitled both to production tax credits and to investment tax credits. We're getting close to the process of having that first step completed and finding buyers for those credits. So that's another, just a couple there. I think I'll stop there.
This sounds amazing. When people hear project finance and tax credits, some people don't really know what that means. So, can you walk us through this process? How does a clean energy project actually get financed from start to finish?
Yeah, so it's a mixture of cash equity, debt, and government incentives or tax credits. And all the participants, those who build it, approve, finance, and buy the product, whatever that may be, need to be brought to the table at the same time and work together to get a project running. And each of those stakeholders has different concerns, different focus in the project. So they all have to be blended together into this complex web of deal chemistry that needs to all gel to get things done.
Who are the players in a typical deal? So, I would assume we've got your developer, lender, EPC, tax credit buyer. Is that correct? And if so, what does each party care about most?
You have the developer who conceives of the project and starts bringing it to life. You have the lenders who provide capital, the equity investors who provide early stage capital. You have the contractors who are all blended into this overall label EPC, engineering, procurement, construction. And then you have another cast of characters who are the tax credit buyers or tax equity. And they are either simply buying the credits at a discount or getting involved by contributing their tax equity, which in reality, although it's structured as equity, is more debt like. And they're able to take the tax advantages of depreciation and tax credits and factor those into their return when they price the equity contribution that they make. So those are really the characters, and each of them, you think about them in terms of the risk that each one is taking. So the developer is taking the most risk and they get potentially the most reward, hopefully. The EPC is really taking a very defined risk, and that maybe they're offering a guaranteed minimum price contract. So they need to be comfortable that they can control the variables in that fixed price contract and limit their risk that way. And hopefully that's covered off by their expertise. And then you have lenders who take construction risk, and they're generally speaking highest in the capital stack. Maybe above them are the tax credit buyers who literally are in it to buy the tax credit worth 100 for a discount. Let's say they're buying it at 95% of face, and they're really taking very little risk. But it's an important piece of the capital structure.
So, we hear a lot about capital stack. Can you break down what that looks like in a mid sized solar or solar plus storage project?
Sure. It varies depending on the nature of the project and the richness of the offtake and the amount of credits that it's getting, whether they be 30% ITC, 40%, 50%, depending on if there are adders in play. But broadly speaking, you can think about it this way. Debt is around 50 to 60% of the capital structure. Tax equity around 30, 35%. And then the balance 10 to 20% is the cash equity that's provided by the developer.
Wonderful. And could you walk us through a concrete example, what the opportunity was, what the risks were, how the deal ultimately closed?
Yeah, let me give you an example of something that is close to closing but hasn't closed yet. It's probably within a month of closing. And this is the clean hydrogen project. And it will be placed in service very soon. All of the equipment is on site, it's being tested. Makes a great video to actually look at all of this. This is actually hard physical plant that's sitting on a site and produces something which is very different. So it has been partly debt finance, but mostly been financed by strategic cash equity, plus a lot of grants from local constituents who are really interested to see this project get built. It's a really important project in the state of California, and local authorities and off-takers are really keen to get this project working, are very excited about it. So there's been a lot of grant money that has been available. And when it's actually in service, it will be entitled to an investment tax credit for the storage and distribution component of the plant. And it will be entitled to a production tax credit for every kilogram of hydrogen that it produces. And so the investment tax credit will repay some of the strategic equity and some of the debt. And the production tax credits will provide an important element of the ongoing revenues to get the low carbon fuel standard credits that it will generate. Unlike the anaerobic digestion facility, which is based in Wisconsin, this particular project is in LA County, and its molecules are very definitely occurring. They're being generated in California, they're being used in California. So it's a very close to the source form of the low carbon fuel standard credits. So that's how, and the balance of the project will, the ongoing revenues will be the revenue that comes from selling the hydrogen to the off takers.
When people hear about clean energy investing, there's definitely a lot of misinformation and assumptions out there. What is the single biggest misconception that you've heard about clean energy investing that you'd like to clear up?
Sure, that if something deserves to get built, it will get built. It just may not. It's not a guarantee.
Why do you think people believe that? And what's actually the truth?
People fall in love with their projects. Developers fall in love with their projects. And you're always, as a financing party, trading optimism with the developer in terms of the level of certainty you want for your return versus the what's left for the developer. The trade for the developer is always that they think that they will be able to get more than a conservative lender or investor will give them credit for in their return. Sometimes the optimism is misplaced, and sometimes the reality is that a lender or an investor will say, I just don't believe it. It's not realistic to think that this is going to happen. They won't finance it. And in that case, the project doesn't get built.
On the flip side, what are the sophisticated players doing differently right now?
So I think the sophisticated developer basically knows what they need to have in place before they approach capital providers. And they're smart if they do that. And that's what they need to be prepared to do, to come to the table with a fully formed, described, and well laid out project before they start asking for capital.
So, if you were advising a family office before they ever had bought their first tax credit, what three things should they verify before signing anything?
They need to know, first of all, whether they have the right kind of taxable income that can absorb tax credits. And so that's the first thing. Do they have, either if they're in corporate form, do they have enough taxable income? Or if they're not in corporate form, do they have the right amount of passive income as defined by the IRS to be able to absorb the credits. And that's the first piece. Then they need to have enough of that income to be relevant. It needs to be realistically a minimum of 10 to $20 million where they can actually say, okay, I can buy a credit of that amount or count on being able to absorb that amount of tax. And by tax, if the tax rate is 30%, and the income is 100%, is 100, the 30 is what they need to focus on. Do I have 100 of passive income on which I can generate 30 million of actual tax liability that I can offset with 30 million of credit? So they need to know they have the right kind of income and that they have enough to be able to be a meaningful participant in a deal. And they need to know, how are they going to find good deals, right? How are they going to be able to find the kind of deal that is properly risk managed for them to participate in?
Speaking of good deals, what are the most common red flags that would make you walk away from a deal or advise your client to walk away?
Yeah, if it's painful to get basic information, run away.
And have you ever had something like this happen where you caught it early on and that saved the deal or maybe prevented your customer from going into a bad deal?
Yes. I worked for a short period of time with a residential solar developer, and they were looking to try and scale their business and find institutional capital so that they could do more deals, bigger deals. And so the problem was that the level of profitability that was baked into the way that they did their deals was just not scalable. In other words, some of the assumptions they were making about how they would structure deals were not assumptions that an institutional investor would ever underwrite and be prepared to participate in one of those deals. So a set of expectations that weren't really matched to the kind of target capital provider that they were hoping to find. They didn't want to change their model sufficiently to make it acceptable to that audience. And fair enough, it helped clarify for them that this was not the kind of market that they should be operating in terms of accessing that kind of capital. They should just carry on doing what they were doing and running the business model that they were running. So we agreed that this was not make sense.
Thank goodness they had you.
I'm not sure they thought that, by the way, because it was an elaborate way of saying, no, this isn't going to work. But I think on reflection, they'll probably come to that conclusion.
In my experience, in all areas, I think a good advisor has to stand up for saying no, and no one wants a yes man around them all the time. So this was a good decision in the end to protect your client. This year has been quite turbulent in politics in the US regarding clean energy, and there's been a lot of changes happening, to say the least. What opportunities are there right now? Are there any opportunities in clean energy investment?
Sure, there are, yes. And one of the things I love about politics in the US is you get every year the chance to market your politicians and tell them, what's what. And I think this week the GOP has been marked to market a little bit by the Democratic Party that seems to have found a little bit of purpose and resolve in appealing to its constituents. And so I think we're going to see that the Republican Party is going to take notice of that, try and figure out ways in which it can adjust. It's had a pretty strong run for the last year of doing exactly what it wants. And the one big beautiful bill has indeed, as you say, been quite a shock to the system for those who had come to be super enthusiastic about the Inflation Reduction Act and everything that promised. So I think Trump will eventually get over his animus to solar because it's a great way to bring more energy to the grid quite quickly. And I think storage, batteries paired with that, and also standalone transmission lines are a way of moving power over distance. Storage is a way of moving power over time. And so I think those things will begin to experience a little bit more acceptability. I think clean fuels that are eligible for the 45Z credits, I think clean hydrogen, nuclear, biogas, all of those things are going to continue to enjoy legislative and regulatory support. But I think we're going to see a little bit of an easing up on some of those things. Wind, I'm not sure. Trump pretty much hates wind. I don't see that moving very quickly. But there will be some things that definitely enjoy a little bit more of a resurgence in popularity.
That's great to hear. So I know that you work with both banks and family offices at Dakota Ridge Capital. Who's moving faster right now, and what does each of them care about most?
Yeah, theory, both can move fast, right? Banks can move quickly if their process boxes are checked and a deal meets their parameters, then they can move quickly. Everybody who's an institutional investor has their investment committee process that has to be followed, and there's sort of time horizons on that and schedules and monthly this and that. Banks can be a little bit slow, but in theory, they can move quicker. Family offices are a bit harder to generalize about because they're a little quirkier. They have their own processes. So I think both of them, depending on the size of the investment, for really large investment, I think banks are definitely the ones who bring the capital quickest and most efficiently. For the small to medium sized deals, family offices may be a better bet.
Let's talk about one of those deals. So let's say someone has 5 to 10 million that they want to invest in 2026. What does a realistic return, risk, and time look like in this market?
That's a great question. So I think if I were running the investment world as I would like to run it with my own capital, right? I think a great place to play is actually bridging to ITC or PTC sales. So you have a developer who's entered into a tax credit transfer agreement or knows it's pretty likely that they will, or a PTC transfer agreement. Those only actually get born at the point where the project is placed in service and the credit comes to life. So before that period of time, you have this period where you need to lay out capital to get the project to that point. I think that period is a great time for a lender to lend to that project against that takeout, mitigate the risks that such a loan would be exposed to during that period of time. And I think you can get a sort of a decent low teens return in a relatively quick period of time, 1 to 2 years. You could have your return, get the capital back, and reinvest that capital. So I think rotating relatively low risk, high return capital over a short period of time is really a good prospect for anybody who has 5 to 10 million to lay out.
Since you're an insider here, we want to give our Macro Mashup listeners the best advice. What is an under the radar niche that they should be paying attention to?
Look, it's not a big secret if you're paying attention to what's being covered in the news every day. The planet is going to be covered in data centers, right? And so data centers need energy, data centers need on-site energy generation, they need on-site storage so that they are not driving up the cost of electricity for everybody in the location where they're located. And so I think that is going to be a really massive opportunity for people to contribute capital to lend money. And so I think any lender or investor who's not taking a serious look at data centers is missing out on a big opportunity.
Speaking from a practical side, when you evaluate a project, what has to be true before you'll recommend it to an investor?
Look, people have long-term investment or lending horizons, but they have a relatively short-term horizon for getting stuff done. They have capital to deploy. They have their short-term personal comp goals to satisfy if they're working for an employer. So what they want to see is projects that are executable in a reasonable time window. Like when you're building your funnels from a marketing point of view, you need to have things that can get done soon. You need to pay attention to building a pipeline for the future that can be short to medium term. And then you need to develop some long term strategic goals. So I think projects have to be executable in a reasonable short time window with a developer who's credible and who can develop and demonstrate that credibility with tangible data and contracts.
Speaking of data, what would a high quality data room look like, in your opinion? And what's missing from the weak ones?
So that's really topical. And data rooms there's massive amounts of technology available to set up data room. And so everybody can do that pretty easily. So a high quality data room should be built around the kind of due diligence that any interested financing party is going to ask for. So the inputs and outputs of the business plan should be capable of being verified in a trip through the data room.
Perfect. And how do you protect buyers if something goes wrong?
Indemnities are a part of that, contingencies in the capital planning, guarantees of the right interested parties to keep their focus where it needs to be on getting the project built. And then insurance, the insurable risks need to be identified and need to be insured on the right timeline. And when you have all of those things together, then you have to think about it from the point of view of what can go wrong, and what can go wrong usually does go wrong in some way. So you have to know that in advance, prepare for it, and put the appropriate risk management structure around that.
You spoke about timing that plays a big role. So, what's the easiest way to tell whether a project is institutionally ready versus still early stage?
You need to know, how has progress to date been funded, right? Has Have risk takers at the developer level put capital at risk to help get this thing built, to get the thing started at least? What has actually been built? Which stakeholders are at the table already in terms of service providers, EPC contractors, conversations with off-takers, utilities, providers of energy to the project, all the resources you need for the inputs? Have those been sorted out, brought to the table, and somehow bound into the project timeline?
Wonderful. This has been so fascinating, Neil. You've given so much great advice, but let's end this interview strongly by giving our listeners, our viewers, depending on where you're getting this podcast from, with a good playbook. What are the takeaways that we can give them? So let's start with investors. What are 3 actions that they could take away to prepare for clean energy opportunities?
Yeah. For investors, they need to know if they have tax capacity. Are they ready to execute quickly with an efficient process, with legal and other advisory partners who can help them get across the line? And do they know what they want and how they want the deal structured?
Wonderful. And now for the developers there who could be listening, what can they do this quarter to make their projects more attractive to capital?
I think they need to know, do they have all of the answers ready that financing parties will need to know, advised by somebody who is able to bridge those two constituencies? If they know what an investor or lender is going to want to ask and have answered, then if they have those answered, that comes across really as an impressive developer who a capital provider wants to work with and knows that they can work with. And if those things are set up well, then things can get done pretty quickly and deals can get closed in a short period of time.
Wonderful. Neil, this has been great speaking with you. Thanks for sharing so much valuable information. For all the people listening here, please follow us at macromashup.com, where we put out a regular podcast as well as a newsletter. And if you're interested in getting help structuring your deals, getting financing, reach out to dakotaridgecapital.com and book an appointment with Neil. Thank you, Neil.
Thanks, Krista. Bye bye.
MacroMashup.